Good morning, everyone. Welcome to the trade findings and adjustments for yesterday, the Monday, the 26th of October. Again, I do apologize for the way my schedule's been the last week. We are going back to normal tonight, being Tuesday. Again, all I can say is thank you for your understanding and letting me go through the things that I felt I had to do to help out my wife's family with a death in her family. Again, greatly appreciated for your understanding, but let's get right into it. Believe it or not, I'm a Facebook guy, and on Facebook, I found a unique video that's about 4 minutes long that talks about billionaires that I'm just going to comment on. Let's watch it to start off. Kind of neat to be able to see this video. It shows billionaires and the growth of billionaires over a period of time. So let's just watch it. I don't know who that is, but that's kind of funny. I guess I probably need to log in, huh? Probably should have had this set up ahead of time. All right. Very interesting video that I enjoyed, but it's not what I'm looking for. I want this video. It's titled Epic Eruption, and it's just the pretty interesting. World's richest people from 1990 to 2020. Walton family is in there right now. DuPont family's in there. Only one USA family. Mars family, DuPont family comes back up. All of a sudden, Warren Buffett starts to jump in there. Very interesting to watch these people just move around. It's pretty awesome. Warren Buffett's number 2, Walton family, which I believe is the Walmart, still number 1 by double. I'm tempted to tell you, okay, so who's number 1 right now? If you think about it, they're not even on the list yet. Paul Allen's there for Apple, I believe. Haas family's in there. I believe the Forest Mars and the other one are oil. Steve Ballmer's in there, Microsoft. Michael Dell's in there. The Walton family split up. Now they go individually. Larry Ellison is in there from Oracle. Oh, 46 billion. Larry Ellison's going down. He's going down. Oh my gosh. Wow, he just lost half his value. Look at all the US people, all the Waltons though. The kids for the Waltons are there. They're going to disappear out of there. Bill Gates is the leader through Microsoft. Some of these ones from overseas I don't know. But it's basically US led by 2004. Again, pretty sure oil is what bumps some of these other people in and out. It's amazing. Look how many times you see fortunes, 1 and then they're halved. They go out by half. Now there's no more US like owning it all. We're only the top 2 or 3 spots. Ooh, Larry Ellison's coming back. He was at 46. He's at 23, 24 billion. One point in time, it was all US people up there. Oh, US lost the top spot to Carlos Slim. Christy Walton's still in there. The Walton family's trying to be part of it. It's amazing. Poor Larry Ellison, been up to 46 billion a couple times, back down. Koch family's down there, Charles and David. Oh, there we go. Now it looks like we're run by the U.S. again. A couple more Waltons are there. These are billions of dollars. Unbelievable. Watch the oil price drop, and then here goes Carlos. Goodbye. Michael Bloomberg's in there now. Jeff Bezos is making a run. Oh my gosh, and now Bezos is really going to run. Zuckerberg's now in there. Larry Page is in there now. Warren Buffett's not the richest man. And that's how it ends right there. Elon Musk jumped in there. Shocking. Shocking for me to see how those fortunes are won and lost. Now, I'm going to be honest with you. I probably could not spend $1 billion in my lifetime. The way that I am, and it's kind of funny because I even messed with my kids. We couldn't even come up with 100 million. If we bought all the cars and the boats and the homes and the land that we wanted, we didn't get to 100 million. Now I have a brother that says, hey, your dreams aren't big enough, which I will politely disagree with. But the short answer is at 100 million, and maybe for me, I could push it up to 120, right? I'm sure I could find a way to spend 120 million. But I found it hard. I actually found it really hard, which was shocking to me because I thought, oh, 120 million, piece of cake. I could find a way to spend that. I could find a way to be there. No problem, right? And in all honesty, it was a problem. I had a hard time spending 120 million where these guys have billions. So part of seeing their fortunes halved, when you've got 46 billion like Ellison, I mean, or Erickson, excuse me, he'll never spend it in his lifetime. And I think it becomes a game. It becomes a game on who has the most and how you can influence the country or the things that you want to. It just was shocking to see everything go up and down. We can't afford to do that. That's the whole point I'm getting at. We as middle America cannot afford, nor do we have the risk tolerance to see our portfolios halved. If you do, go stick your crap into a fund somewhere, right? You don't need Hurley Investments if you are okay with seeing your portfolio lose 30-35% of its value like it did earlier in the year. If you're okay with that, I've got nothing for you. I do not have, and I am not the guy that's going to be helpful to you in, I'm just not going to be. That's the short answer. The short answer is I'm not the guy for you. And that's a little sad because I think what I'm doing is going to be beneficial for everyone, but it's hard. In all honesty, it's hard sometimes to sit through stuff. We've been fed a little too much about, oh, it makes up every penny on the way down. It doesn't. In all honesty, nobody does. You get hit up with, oh, I'm making 60% returns. Well, if you're making 60% returns on 10% of your portfolio and the other 90 is protected, you've got to put that into perspective. And I just showed that video because there's a perspective here on what we do. At Hurley Investments, we are protecting your portfolios. Excuse me. We are middle America. We can't afford, nor do I have the risk tolerance to see my accounts go down by 50%. I can't do it. I don't want to do it. I don't ever want to be in that scenario because I panic. When I see those dollars of all those hard years of work that are put in through 401k and through trading, I panic. I can't do it. So for that reason, because I don't have all the money in the world and I can't afford just to let things go, I collar trade. I protect through the downturns. That is what we do here, and this is why. Last week, we are going through our best October. Boy, I want to say in like recorded history. Best October I can remember. With 5 sessions remaining, the S&P is up 3% for October. The SP is up 7.3% year to date. That was before yesterday's 2.2% drop. So in all honesty, October is basically flat. Technology had the largest drop of the week. So last week, technology was down 2.2%. How would I say this? It seems like a big drop, but they were more concentrated to some of the bigger names for antitrust and so forth. There was one last week that I'm completely mind blanking right now that really took it in the shorts that kind of brought everything down. But short answer, technology's had a good run this year. It's where we're going to sit back and put our money into it. It was Twitter, right? No, Twitter rose 10%. Which fell down? Kimberly Clark fell 11%. Citrix Systems fell 11%. Maybe that's what I was thinking of. Short answer is there's still quite a bit of drops that we're seeing and are expecting here in our market in the near future. Big earnings this week: Microsoft, Pfizer, 3M, Caterpillar, UPS, Boeing, Apple, Amazon, Google, Facebook, ExxonMobil, Chevron. It's just a busy, busy day. Let's face it. Busy week. We are going to be moving like there is no tomorrow. If you ask me where we're going to end this week, I'm going to say lower. When you have 3% in a month like October that is historically down for the month, we're going to be lower this week, even though we have some big earnings. On Friday and yesterday, actually, it's yesterday, we turned bearish. We have our crossovers on the RSI. We've broken the 50 on the Dow. We're getting our crossovers on the MACD. We are bearish, but if you notice on the Williams percent R down there at the bottom, we're almost getting to that oversold stage. It would not surprise me to see some bigger names possibly move our markets at least back above the 50-day, in which case if that happens, we're going to have about a 3% close of the month. The S&P just barely tried to hold on yesterday. It did not hold on to the 50-day, but looking at the markets this morning, probably going to bounce back above it. It looks like we have a positive open. The chart is equal or reminiscent of the Dow. Crossovers on the RSI, crossovers on the MACD just barely. We would have crossovers on our 20 and 5-day EMAs if that's what you use. 15 and 30 would show it. But we did not hold the 50-day. We'll see if more money comes in today, Tuesday, for that bounce. I have the NASDAQ is still technically bullish. It's close to crossing, but we don't have our RSI. So we'll see where we end up. That's the short answer. We're going to see where we end up, and in all reality, we've got so many earnings and the election next week that there's not really a great. This is not the week that you go out and you guesstimate where the markets are going to end up. Technicals are there. You notice the technicals. 50-day simple moving average holding will be important. We've got a dozen big name companies that are reporting. It's earnings. It's a busy earnings week. In fact, it's so busy. We're going to go down to earnings. They're just some of the ones that I'm watching. Busy, busy, busy earnings this week. Market movers. You will notice where will the S&P end October, even with the sell-off that I'm expecting on Friday. I'm sticking with the 3% where we're at right now. In all honesty, I'm just saying, hey, I believe our markets are going to finish on the trend that they have, an up market for October, but I have no real idea where our markets might go for November. Election comes up, big week of earnings. I'm just protecting. That's what I'm looking to do. Add protection, have protection on through the election. Tons of those there in earnings. Please feel free to look over it as you want to. If I was just to pick some out, Hasbro for yesterday, 3M Caterpillar, British Petroleum. I do like Crocs for Tuesday. I still follow Crocs along. More importantly, on Tuesday, Microsoft, Eli Lilly, FireEye, First Solar, Akamai are reporting. JetBlue might be fun to watch. Pfizer might be fun to watch on Tuesday. Wednesday, General Electric, UPS, Amgen, Beyond Meat, Boeing, MasterCard, Ford, Visa. Thursday's a big one. Twitter, Apple, Facebook, Starbucks. Big ones I'm going to be watching. Friday, oils, Chevron, Clorox, ExxonMobil, Honeywell, Under Armour, Altria. Just some big ones that are coming up that I follow, that are on my watch list, and I'm going to go through. All right. Where else are we here? Economic reports. Our big economic report is on Friday, which is also the day of options expiration. For plain and simple, how would I say that? Plain and simple, Friday we're going to be all over the place. Don't let the Friday's big moves surprise you or shock you. Also, don't take anything off. We've got the elections next week. Even if stuff looks good and your stock shoots up because of earnings, keep your protection on. Maybe turn into a barefoot put. Put that short put where you have some space, because most likely we're going to be so volatile in the next week that it just doesn't make sense to let it ride, at least not for me. Thursday, Bank of Japan and the ECB have their interest rate decisions. The Euro has their GDP report. Earnings are coming up. I've got everything protected for earnings. I'm just getting ready for it. I found some interesting articles. Why Buffett, Cuban, and Munger all hate diversification. Here are some of the world's greatest investors. It's a link. You need to click on the YouTube link. Maybe I'll put that YouTube link in there as I go through, but it's very interesting on why these individuals don't like diversification. Really comes down to laziness. Laziness. I put this in here. Biden's tax plan created a tax rate as much as 62% for New Yorkers and Californians, studies show. If you live in those areas, please understand who you're voting for and why. Look at their platforms. I would suggest you go through this this story, verify the numbers. I've done some basic fact checking, and it's all right there, pretty easy to see. As I was traveling last week for Family Matters, Keith said, hey, I saw this article, and I saw it too, about record buying prices for used pickup trucks. I found it very interesting. No one wants my pickup truck because it has 260,000 miles on it. But what a neat trend it is for pickup trucks, and a demand that typically you just don't see. Interesting article, not important to our trading. I just threw it in there because I liked it. Apple Chinese user mainly snapped the iPhone 12 and 12 Pro models. Very interesting to see how well Apple is doing selling their 12. I agree and I disagree, but I wanted to go over this with you. 7 secrets smart professionals use to choose financial advisors. This is not everyday America, okay? The plain simple, this is not, hey, I need a financial advisor. This is for the ultra wealthy. But plain and simple, here are some rules that they use when it comes to finding and using an advisor that I thought would be helpful for you guys to see and hear as well. You always hire an advisor who's a fiduciary. And all that means is a registered investment advisor, for an example, not necessarily a stockbroker, but a registered investment advisor is a fiduciary, which means we are supposed to, and our licenses ethically bind us to act in the other person's best interest. That doesn't happen if you're using funds. Plain and simple, if you have an advisor that's putting you into funds, there is no way in hell that he is acting in your best interest. He's actually doing diversification because he's a lazy SOB. Personal comment there. Please feel free and watch that YouTube video up above about diversification. You'll understand where I'm coming from. Don't hire the first advisor you meet. For some of these people, they get, in all honesty, for some of these ultra wealthy, they meet these advisors in a party, in a club. Obviously, that is not where you should be looking for your advisor. Just because your advisor can go to a club, party with you, that does not qualify them as an advisor that you are looking for. Don't always meet the first advisor, especially if it's in a club. Don't choose an advisor with the wrong specialty. There are a lot of people that specialize in retirement planning, aka annuities. You see hedge funds. There are all kinds of specialties. You need to find out what works for you. If you have tons of years still left until retirement, you shouldn't be in bonds. Plain and simple. You don't have the opportunity to make enough. If you're ultra scared of the market, then maybe that is the reason why they put you in bonds, but you have to be able to go through and understand what their strategy is and if it works for you. Ask about credentials. They should have their series 7, 65, 63, 6, 24 there, mine all listed out. Understand how they're paid. You should understand how they're paid, and you need to dig into it, because paying people, you need to understand if they get commissions off of funds. That helps you understand why you're going to get churned in and out of funds all the time. And I disagree with number 7. Do not hire an advisor on your own. Of course you should hire an advisor on your own. It's your money. It's important for you. Make the decision yourself. Stand up for it. Help be accountable for your decisions. Again, maybe I don't understand what they were looking for or trying to say here, but I would tell you most definitely hire an advisor on your own. Hold yourself accountable for that decision. Make sure you're making the decision on your own so you can't go back and, in all honesty, blame someone else down the road. This is your money. This is your funds. This is your retirement. Stand up and make the decision. I found an interesting article. Hedge fund giants lose their appeal. You've got to go through this. And again, it just comes down to when you're hedging a commodity against an equity, a commodity against a commodity, the hedges are wrong. Our new normal that we learned really back in 2000, you can see all things fall. All things fall. So plain and simple, hedge funds are hedging incorrectly. They're not getting you the protection that you think that you want or need. Very interesting to go through and read through this. Plain simple, you should not be paying 2 and 20 ever. Last but not least, rising rates seem to signal recovery is near. We have this inverse relationship between bonds and the stock market. It's just an interesting article that's taking some historic data here that I think you'd find pretty darn interesting. So please spend some time reading through it. And I guess it's a unique article that says, hey, stock market's not dead yet, so don't worry about it. Guys, I appreciate you being with me. I'll get this uploaded here immediately. Thank you for your understanding. I look forward to seeing you Tuesday night at 6 p.m. Mountain Standard Time. It is just a Q&A for you guys to ask any questions, to kind of shoot the bull. I'm traveling, so I'm going to be on the road for 10, 12 hours. And guys, have a great day. Bye-bye.